Hello, scholars. Today we are going to discuss more about categories of mutual funds. In previous video, we discussed about Act of God. That means that is a classification of mutual fund, active versus passive, categories of mutual funds, tax rate based classification, growth versus dividend and income distribution. Forget that. Growth, open ended, and direct plan. Okay. So in that case, we discussed a few things about actively managed, passively managed, and we also discussed about the different categories as per SEBI. Today we'll discuss more about equity category. Before we start equity category discussion, let's understand few basic terminologies used in the mutual fund. So the categories of mutual funds are mainly equity category, debt category, hybrid category. These are depend upon the underlying assets, equity asset, debt asset. We will discuss today equity asset. Another term used in the mutual fund is asset under management. It is called as AUM for short form. That is asset under management. What does it mean? Write down. Asset under management is the total asset of mutual fund, which includes the money invested by investor and their capital appreciation because of price appreciation. So that is total assets, asset under management. Practical application of AUM or asset under management, that we do not invest in any mutual fund which has asset under management less than 500 crore. Okay, we do not invest in the small mutual funds, small size mutual fund, because in such cases expense ratio is high, and these are very new funds or poorly performing funds. So we don't select any mutual funds which has less than 500 crore AUM. This is a practical application, and reason I also explain why. Then next is NAV, net asset value. So net asset value is the price of one unit of mutual fund. For practical purpose, you remember now. Now is this is now. Okay. Now is bhav. Okay. Now is bhav. In Marathi, Gujarati, Hindi, we call this bhav means price. So what is now? Now is nothing but the bhav, is nothing but the price. Now is bhav. Easy to remember. Write down few things about now. That is net asset value is calculated daily after night 11 p.m. by the asset management company. How it is calculated? First, they calculate the value of total asset. Total asset means equity and debt, and then they subtract some expenses and if any liabilities. Okay, and what is the main is a net asset. And there are mutual fund has issued number of units. So net asset divided by number of total number of units of mutual funds, and the ratio is nothing but the NAV, net asset divided by number of unit is equal to now. You don't have to calculate now. It is the job of mutual fund company. You just understand now is bhav. And another practical point of here, that your now or bhav will be reduced if there are a lot of expenses. Okay, expense ratios, cost of fund management. Okay, another line, next line is now is depend upon. First is cost, that is expenses. Second, prices of underlying asset. Mutual fund invest into the shares. If share price goes up, now will go up. Share price goes down, now will go down. So your portfolio value will fluctuate because price or now will go up and down, right? So this is brief about now. Next is expense ratio. I explained that expense ratio is the total cost of fund management, including agent charges, divided by the net asset under management. Okay, asset under management, that is a ratio. It is usually 2 to 3%, which is actually very high. Detail we'll discuss again in separate video. These are the few terms which will be used and detail will be explained in a separate video about performance metric. Once you buy mutual funds, you have to measure its performance. How do you know this mutual fund is performing good or not? So there are some metrics. This is called as extended internal rate of return. Then there is called as compound annual growth rate. Then there is concept called as alpha. Sorkinose ratio. This represent performance. So detailed discuss will be later on, because this is just introduction. So I'm just giving you some names so that you will be acclimatized to the words they are using. Then risk parameters. When we are investing any financial instrument, we must know what are the risk and how to measure them. So there is a concept called a standard deviation of return and beta. We'll again discuss this again in a separate video. Okay. And the portfolio of mutual fund, which will have component equity and debt. So these are the basic terms. So let's understand now the underlying asset, equity and debt. Now, this is how I try to explain in a simple language, because our audience is not a finance professional. So I don't want to give the jargons which will make your life complicated. Instead of that, I'll give you a very day to day example and you can correlate with. So we have dal, we have rice. We can eat separate dal. Dal means I'm giving a debt product, and equity means rice product. I think dal is understood by everyone in India from north to south, so I don't have to explain complicated manner. So you can eat dal separately. You can cook rice separately as well. Dal has its own feature, different type of taste, texture, consistency, all. Similarly, rice has its own taste, texture, consistency, nutritional value. And you know that complete diet is dal and rice, because there are certain amino acids, essential amino acid, which are lacking in the rice, which will be completed by the this dal. And there are certain amino acid which are deficient in dal, will be compensated by the rice. Okay, so I'm giving a very easy example just for understanding purpose. The price behavior of the debt product is slow and steady. The price behavior of equity product is rapid and volatile. So ultimately, your return and risk will be depend upon the price. Bhav Bhagwan Che. So from today onwards, you can start saying now Bhagwan Che. Net asset value is now Bhagwan Che. Okay. And it everything depends upon the price. So let's understand how the price of debt product behave. So you see that this is one mutual fund, which is a debt category of mutual fund. It is ICICI Pru. Please note that all these examples are just for the illustration purpose. Do not go into invest. You'll have to select your own fund after learning the course. So you see from here, this is a 5-year chart. If someone invested 100 rupees 5 years ago, his value of fund is increasing steady, slow and steady. And in 5 years, his value will increase by 130 rupees, from 100 to 130. So this is how debt product price behavior is this. Suppose someone invested in the equity product. Okay, this is debt, and now I'll show equity product. He invested, and his money would have been become now 300 rupees, three times. Okay, so what you understood from here is one, that debt product gives less return, equity product gives more return over the 5-year period. But one thing you also noticed, the way in which prices are moving. So this is going steadily, slow. It's like Rahul Dravid, slow and steady. This is like Yusuf Pathan or Virendra Sehwag. So price is going very volatile, up and down. This is called as volatile product. And for the people who are new or they are not aware of this, price fluctuation may cause little discomfort to them. Okay, so the idea of investing is to combine both of them. So you will get, when you do the dal khichdi, like So the idea of investing is to combine both of them. So you will get, when you do the dal khichdi like this, so you are getting best of both. Dal khichdi, where you are combining equity and debt. Now you see that this is another product where here equity component is I think 20%. Now you see there is very slight variation, but now price has goes to 60%. So you have seen in a debt product, it 100 rupees become 130, but when you add little equity component, you are getting 160. Okay, total value with slight fluctuation. So fluctuation is reduced significantly. Another mutual fund which has little more equity component around 60%. So it is giving you 200%. 200% means 100 rupee has become now 300 rupees. Okay. Previously it has given 300% return. Here it is given 200%. But the volatility is less as compared to, I'll show this equity. Volatility means, what is volatility? In a common term is price fluctuation. Okay. We'll discuss a technical term which is called a standard deviation that later on. But for today, what you remember, volatility means price fluctuation. Now I'll make this, see the comparison. Here equity company is, let's say 100%, although it is 98%. Here equity component is 60%. Remaining is debt. So equity product is moving like little high volatile, and now this is low volatile, although it is not straight like debt product. But what we have done here is we have combined here, in this case, we have combined the feature of equity and debt. Here you got 300% return. Here you got 200% return. But your portfolio value has become steady. This is the advantage of, it is called as diversification. And mutual fund help us to diversify portfolio even at small amount. And that is how you create a portfolio according to your risk preference. If someone says, I don't want to take risk, in that case, you can select the mutual fund which has less volatile, but it will give more return than the FD return. Okay. So you remember the goal is PPG, that is parking of the funds where you are not concerned about return, then protection where you are interested in 6 to 7% return, and growth where you are interested in more than 10% return. Okay. So you understood dal, rice, and khichdi. Okay. So now when you analyze your mutual fund, you are going to find out the composition, how much dal and how much rice. When we discuss the mutual fund, I'll demonstrate each mutual fund with specific how much component is then how price behavior is that. Okay. So you understood equity, debt component, and how when combining we can change the price behavior of mutual fund, that is a khichdi. Now let's talk about few things about only equity. Okay. So equity means what? Equity means shares, buying shares. Now there is a slight difference between shares and stock, but for practical purpose, keep the same. Okay. Share and stock, there is a slight technical difference, but for practical purpose, consider both as the same, share and stock. What is share? Share is the ownership in the company. For example, if you buy one share of Reliance, you are the owner, not 100%, but the fraction. It is a fractional ownership. So that will be the right word to say. What is share? Is the fractional ownership. Fractional ownership of the company. So these are the definition or terms which you have to remember, because the concept are depend upon the definitions. What is share? Share is the fractional ownership in the company. You are shareholder. Next, when you buy shares of any company, what rights you get? You get the rights to get the dividend. If company declares the dividend, you get the dividend. Suppose Reliance declare 50 rupees, 60 rupees, 100 rupees dividend, it will be credited to your bank account. But when you buy the mutual fund, the dividend will not come to your bank account, but dividend will go to the mutual fund bank account, and they will reinvest the amount in the asset under management. So dividend is collected by the funds. It is not given to the investor. It is collected in. It will be automatically included into the now. That is net asset value. Now, as of now, focus on the shares. Keep aside the mutual fund apart. Focus on the shares. So when you buy shares, you are entitled to get dividend. If company is closed down and assets are liquidated and distributed, shareholder will get remaining asset. Practically, it never happens, because when company die, it is mainly because of huge loan, and the lender and when the vendor takes money, shareholder gets nothing when company is liquidated. For example, Anil Ambani's company is liquidated, shareholder will not get anything, because loan and lenders will take everything. But theoretically, they have the right on asset. Second, common shares have the voting rights. They can do the voting in the general AGM. For retailers, this is also not much useful. It is only useful for big shareholder, those who want to influence the management. So how do you benefit from the buying the shares? That is the whole story of buying shares. So one benefit is that you get the dividend. Other is price increase, price growth. It is also called as capital appreciation. That means increasing the price of the shares. And when you buy at certain price and sell at higher price, you get the profit. For example, you buy share at 100 rupees and sell at 150 rupees, then you are getting the profit. Okay. So how do you get benefit from the buying shares? Dividend or price appreciation. Now, the most important part, Bhav Bhagwanji, how does price of shares move? What decide the price? Who decide the price? Is the shareholder. Okay. Shareholder, you can say the investor in the market. Shareholder, that means those who want to buy shares and want to sell shares in the stock market, they decide how much price that share should be. And it is based on the demand supply. So write down. Share price is decided by the demand supply in the stock market participant. Full stop. Okay. Now, how do these participant decide which share we have to buy? Is there any basis or underlying assumptions? Answer is yes. The price of shares is based on the profitability of the company. See, company do the business. So profitability of the company and the perception about that company and business. This is perception of the investor. And this is the profitability of the business. So there are two factors which decide the share price. We can say multiplication as well. Okay. Equal. They are not talking 12. So share price is equal to profitability and multiplication of the perception. Now, you cannot measure the perception directly. We can measure perception based on the another formula is profitability means earning per share. It is called as EPS, earning per share. So how earning per share is calculated? Let's say company made a profit of 10,000 crore. Okay. And company has 1,000 crore shares. So earning per share will be 10 rupees. That is total profit divided by total number of shares will be earning per share. Okay. So price of shares is depend upon earning per share and PE ratio, that is price to earning ratio. Now this is a retrospective calculation. You may say, how can PE ratio can be calculated without PE? No, that is not calculated. So this is just calculation based on the price. So price is equal to earning per share multiplied by PE. PE means this P again. Okay. Now the earning per share does not change. Earning per share does not change frequently. It takes every quarterly. But the share price changes every day. What does it change is the P. And this P indirectly represent the perception or sentiment of the investor. Okay. So perception changes and price of share changes. Okay. Now, when you are investing in stock market, there are two main risks. One risk is losing the capital. Whatever you invested, that capital will become zero or very small. and it happens mainly if company business is not good. Okay. Another risk is price fluctuation, price up and go. So this depend upon the perception of investor. For example, recently TCS price, Tata Consultancy, Infosys prices are down. Is profitably has gone down? No, profitably is fantastic. What is gone down is the perception, because of Trump has created a negative sentiment in market, and negative sentiment causes price depression, and this is because of perception. So the perception, emotion changes every day, and that's how volatility changes. There are three types of equity mutual funds classification I demonstrated yesterday based on the size of the company, that is market capitalization based, large market capitalization, mid capitalization, small capitalization, micro cap, penny cap. So as of now, forget these are very small company, but large, mid, and small, which we invest. Then companies can be classified based on the sector, in which sector is operating, like bank, oil sector, pharma sector, IT sector, health sector, telecom sector, and so on. And companies can be classified based on the value, growth, momentum. This is not for the passive investor or the beginners. This is also not for the you. So what is for you is this: is to learn on this based on the market capitalization and start investing. What is market capitalization? It is the share price multiplied by total number of shares. It is market capitalization. Now the market capitalization of Reliance is around 18 lakh crore. Okay, with TCS is around 16 lakh crore, HDFC is around 13 lakh crore, and so on. So this market capitalization is nothing but the number of shares and multiply by share price, current share price in the market. So based on this, companies are ranked as per market capitalization. Top 100 company are called as large cap, next 150 called as mid cap, and remaining are small cap. Okay. What is the assumption of investing in this market cap based mutual fund? So this is an assumption. The assumption is that small cap companies are volatile but gives more return. Large cap companies are stable but gives less return. So these are the two assumptions of practical importance. It means if you want to get more return and if you are comfortable with volatility, large cap is the choice. If you don't want too much volatility, then large cap. Return is less but stability. Okay. So these two basic fundamentals assumptions come into picture of investing in the equity mutual funds. So as I mentioned, we will invest only size based mutual funds, which are includes large cap, mid cap, and small cap. Okay. So we'll take the real example as well later on. But as of now, this is the theory, and I request you to write the notes and answer the questions in the assessment form. Okay. Thank you very much.